Welcome viewers. I am R. Amuda from School of Management, Sastra University. I welcome you to this session, Introduction to Accounting. We shall now see the need for accounting, objectives of accounting, advantages of accounting, and the various terms used in accounting. Every human being wants to lead its life. To lead life, all human beings are supposed to undertake an occupation. Human beings are continuously engaged in some activity or the other to satisfy their unlimited wants. These occupations are called as human occupations. Human occupations are broadly classified as employment, profession, and business. Let us now see these classifications in detail. First, we shall see employment. Under employment, one has to work under the another person called as an employer. The person who works for the employer is called as employee, and he works for a remuneration called as wages if it is daily paid, and called as salary if it is monthly paid. The employee has to adhere the standing instruction of the employer, and this may be otherwise termed as the term of employment. The relationship between these two persons is employer-employee relationship. So under employment, one will work under the another, and that will be for under a specified terms of conditions, and they will work for a remuneration. It may be wages or salaries as the time may be. Next is profession. A person is called as professional if he has acquired professional knowledge, that is, any expertise or know-how that is obtained through continuous practice or repeated practice. The relationship between a professional man and the other person is called as professional man and a client. If this professional works as an independent person, he will be called as a professional man. And if this professional goes for an employment in a different institution, then he will be called as an employee. So when we say a person as professional, he may be expertise in a particular field. Say for example, a doctor cannot do a job of a lawyer, and a lawyer cannot do a job of an engineer, and an engineer cannot do a job of an auditor. So each and every person is expertise in his own field. He is specialized in his own field. That is called as profession. So when this professional service is given, this is said to be intangible, and whenever the services are given, you will pay the fees to the professional man. So it is not called as salary, or it is not called as wages. It is called as professional fees. That's why this profession is said to be somewhat unique than your employment. So when this professional man goes for an employment in an organization, assume when a lawyer is going for an appointment in a bank as a legal solicitor, or going for a corporation for a legal solicitor, then the employment exists. That is, the professional man becomes an employee. Next comes the business. When we say business, it is a combination of industry and commerce. Industry deals with the production of goods and services, and commerce deals with the exchange of goods and services produced by the industries. So when we say business, it is a combination of production and exchange, wherein the production is carried on by the industry and exchange is carried on by the commerce. Now we shall see the different types of industries. First one is the manufacturing industry. When we say manufacturing industry, it is mainly engaged with the transforming of your raw material into a finished product with the help of your machines and the manpower. The finished goods may be consumer goods, or it may be producer goods. When we say consumer goods, that are the goods which are consumed by the end user. Producer goods women, the goods which are purchased by the industrialist for further processing or for assembling purposes. So that is called as producer goods. The best examples of manufacturing industries are textiles, chemicals, sugar industry, paper industry and the like. Next comes the extractive industries. Extractive industries deals with the extraction of natural resources beneath the earth. So we are going to take the natural resources below the earth. That may be iron ore, coal ore, quarries, etc. That is called as extractive industries. We are going to extract the natural resources. Next comes the genetic or primary industries. When we say genetic industries, these industries are dealing with the reproduction of plants and animals. The best example will be cattle breeding, fisheries, animal husbandry, plant nurseries, agriculture, horticulture, etc. Next comes the processing industries. Processing industries deals with the production of goods with the different processes. Say any one manufacturing industry may be a processing industry. That is, its manufacturing process will pass through different stages. Assume we have 4 stages. So the input will be made in the first process, and the output of the first process will be the input of second one, and the output of second one will be the input of third, and again it goes to the fourth, and the last one is your finished goods. So the output of the 4th stage will be transferred into finished goods, and it will be taken to the stock. The best example will be petrochemicals, textiles, food, beverages and the like. So we have different stages of production. Say in textile industry, we may be weaving industry, spinning, weaving, dyeing, printing, etc. So we have different stages in your textile industries. That is called as processing industries. The next is construction industries. Construction industries, women, the industries which are dealing with the construction of buildings, dams, bridges, roads, etc. So in this construction industry, we go in for the fixed layout. Fixed layout, women, the product will be in a static stage, and the materials, men and machinery will move to the product. So this is called as fixed layout. This is concerned with construction industries. Next comes the service industries. All these service industries provide the intangible products. Intangible products, women, which cannot be seen and which cannot be felt. Which cannot be seen, but it can be felt by the consumers. So that is called as intangible. The best example will be banking, insurance, entertainment, medical, legal, transportation, hotel industries, tourism, educational institutions, etc. So all these industries are said to be service industries. They will render the services which are said to be intangible, which cannot be seen, but that can be felt. Next comes the assembling industries. Assembling industries involved in the assembling of the products with the various components or with the various parts produced by the other industry. So it includes the car, television, computers, mobile, bus and lorry manufacturing. So these are all the industries wherein we are going to produce the goods and services. With the production of the goods and services by the industries, now we go for the exchange of goods and services. So this exchange is done by the commerce. So when we say business, it combines the production and the exchange. Now we shall see the various features or various characteristics of a business. What constitutes a business? We normally used to say business is said to be a state of being busy. Beyond that, we have certain features or we have basic points which will determine the nature of a business. Now comes the first one is dealing with the goods and services. So that is the foremost characteristics. We must deal with the goods and services. So as we already said, it deals with the exchange of goods and services produced by the industries. This exchange of goods and services is technically called as a transaction. So any goods and services that has been transferred for a common medium of exchange called as money, it is called as a transaction. So any transaction, any single transaction will not constitute a business. We must have a repeated transaction. We must have a continuous transactions in a business. Assume if I want to replace my car, old car, I am selling my old car and I am purchasing a new car. So this is for my consumption purpose. So this will not constitute business. Now we have another organization which is dealing mainly with buying and selling of your second hand cars. So that is your business. In a day, we may have numerous transactions. We may have more than one transaction relating to the purchase and sale of cars. So this is a business. So a single transaction does not constitute a business. We must have a repeated transaction. Next one is profit motive. So this economic motive is normally had in case of profit making organizations. Any transaction carried with the profit motive is called as a business transaction. Profit will be determined as a percentage on cost. This profit is determined mainly to cover all the operating expenses plus a smaller percentage that should be taken by the owner of the enterprise for the purpose of taking stress and strain to conduct the business. So cost plus profit will give you your selling price. So this profit element is said to be the major economic incentive for any owner of an enterprise. The next comes the risk factor. Risk factor, women, we take business risk, we take business risk, then market risk, into consideration. So this is said to be the various risks that has been faced by an entrepreneur. So business market risk is the change in the tastes and fashions of your consumers, change in the lifestyle of the consumers, the introduction of new products by your own competitors. Then we have the change in the economic trends in a nation. So these are all the market risks we are going to face. Business risk is the assets that has to be utilized in an organization. We call it as traceability of assets. Any owner of an enterprise must be able to trace his own investment in the business. So only when he is able to trace and only when he is able to know the various places in which he has deployed his capital, he can be successful in an enterprise. So any risk factor will be business risk and market risk in an organization. So to constitute a business, we will summarize. We will have a repeated transaction and a continuous transaction, and we have the profit motive in the organization, and the last one is undertaking the risk in the business. Now we shall see the definition of accounting. Before going the definition of accounting, we shall see the very basic need for accounting. As we already said, the very basic feature is a repeated transaction in a business. So when we have a repeated transaction in a business, any entrepreneur or any owner cannot remember all the transactions in a chronological way, that is according to the time of occurrence. So for this purpose, accounts are maintained to replace the memory of an owner, to facilitate the recording of all your transactions in an orderly way. We need the accounting records. So accounting is an information system to this uses of your decision making, and it speaks about the financial condition of the business. Normally we say accounting is said to be the language through which a business speaks to the outsiders and also the insiders. These outsiders and insiders are called as the stakeholders. When we say stakeholders, that is a degree of interest in the business. So these stakeholders will have some or the other, that is the degree of interest, some or the other way of interest in the business. Assume when we have the consumers of the product, they are interested in the prices of the product. When we say the government, they are interested in the payment of the corporate taxes. When we say the society, it is interested in the corporate social responsibility of a business, because as per the Act, every organization can spend 2% of its net profit towards CSR. Again, when we have an employee, these employees are interested in the amount of bonus they are going to get depending upon their own profit rate. Again, the investors are interested in their return on their investment. The creditors are very much interested in the security of their principal. So all these persons, whether an insider or an outsider, they are very much interested in the performance of any organization. The performance of this organization will be revealed only through the financial statements. So the accounting information in the form of statements is very much essential for a business organization. Let us now see a definition of accounting. First one is American Institute of Certified Public Accountants defines accounting as. First one is art of recording. Recording women, it is recorded in the book of prime entry. That is the first journal book of prime entry women, book of first entry called as journal. So we are going to record all the transactions in a chronological way. The next one is classifying. When we say classifying, we are going to segregate the transactions of a similar nature. Say for example, all the purchases are recorded in purchases account, all sales are recorded in sales account, all cash transactions are entered in cash account. So this is the way in which we are going to segregate all your transactions and record it in the ledger. The next is summarizing. The summarizing will be made in a trial balance. We are going to summarize the different balances of different accounts to know whether the business has earned profit or suffered a loss. And in terms of money, so we are going to enter only the money transactions here and events which are in part or at least of a financial character. So there are certain transactions which may be partly in financial character and partly it may not be in financial character, and interpreting the results thereof. So just preparing the accounts and keeping it in your ledger is not enough. We are going to interpret whether the business has made a profit over the years, whether the rate of increase has increased or whether the rate of increase has decreased. So we are going to see the different financial position. Say for example, the asset backing. We are going to see about the working capital position and what is the liability that is owed by the organization, what are the collections to be made by the organization. So we are going to interpret the different accounts. So I'll summarize now. Accounting is the art of recording, classifying and summarizing in a significant manner. So only the significant transactions are entered, and in terms of money transactions and events which are in part or at least of financial character and interpreting the results thereof. Next comes the meaning of accounting. We shall see what are all the meaning that has been derived from your previous definition. First, as we said, it is a recording. So recording will be made in journal. It is concerned with the recording of financial transactions in an orderly manner soon after their occurrence. So immediately after occurring, they will be recorded in the proper books of accounts. Next is classifying. It is concerned with the systematic analysis of recorded data to accumulate the transactions of similar type at one place. As we already said, the grouping of your transactions will be made in ledger. Next is summarizing. It is a preparation and presentation of classified data in a manner useful to the users of your accounting information. It may be internal or external users. Next is interpreting. When we say interpreting, the accountant should explain not only what has happened in the organization, he has to reason out for the happenings, why it has happened and what is likely to happen in future and how it can be prevented or how it can be promoted. So all these items will come under interpreting. So when we say meaning of accounting, it is recording, classifying, summarizing and interpreting the various financial information. From this definition of accounting, we shall now derive the various objectives. We can say the main objectives of accounting. First one is, as we already said, it provides a useful information to the interested parties. The interested parties here again I mean the stakeholders. Then maintain systematic and complete records. So whenever you want to refer to your previous year or your previous week or your previous month, it should be easy to know about or easily accessible to the various financial statements. The next is to protect the business properties. So we are going to say what are all the fixed assets, what are all the current assets, how they are maintained, what is the depreciation rate, when it is purchased, how it is used, the utilization rate. So all these things must be clearly defined. Then to facilitate rational decision making, this is very important. So with this financial information, the business owners, and if it is a company, the board of directors have to decide about various matters, whether to drop down a particular division or to drop down a particular product or to enhance the promotion of a particular product, to increase the production of a particular product, or to have the utilization of existing idle capacity, or to go in for a foreign order or not, or whether we are going for an additional plant, or whether we are going to expand it to the next region, increase your sales. So all these items will be made only, all these decisions will be made only based on your financial statements. Next is to calculate the profit or loss. This is very important. We must know whether the organization is making a profit over the years. Suppose if the rate of profit is slowly decreasing, we must find out the reasons for your decrease in profits, and all these reasons must be removed, and we must find out the ways of improving the profit. The next is ascertain the financial position of the business. When we say financial position, it includes both the assets and liabilities. So all your liabilities are said to be the various sources of finance. Either it may be owned finance or it may be borrowed finance. But when we come to the asset side, it is the application of all your sources. So all these sources must be applied, and we have to see whether all the applications are being effectively used. So these are the basic objectives of accounting. So it provides accounting information to the stakeholders. It provides a systematic record of your business transactions. It protects your business properties. It helps the management in taking decisions. It helps to calculate the profit or loss and to ascertain your financial position. Now, the process of complete and systematic keeping of monetary transaction of an organization by the bookkeeper is called as bookkeeping. Now, this is the meaning of bookkeeping. So, the systematic record is called as bookkeeping. The purpose of bookkeeping is to disclose the correct picture of income and expenditure at the end of your accounting period. So, bookkeeping is said to be the first stage and accounting is said to be the second stage. So, the work of an accountant begins where the work of a bookkeeper ends. So, when the bookkeeper is going to maintain all your books, based on the books, we are going to prepare all the accounts. There are two methods of bookkeeping. First one is single entry system and next one is double entry system. In single entry system, all the personal accounts and the real accounts are kept. So, no nominal accounts are kept. But in case of double entry bookkeeping, all the personal accounts, real accounts and nominal accounts are kept. So, all the three accounts are kept. So, single entry bookkeeping is said to be a set of books wherein only personal and real accounts are kept. So, the nominal accounts are not entered here. But in case of double entry bookkeeping, we have personal accounts, real accounts and nominal accounts. Now, let us see the various branches of accounting. The first accounting is said to be financial accounting. So, this financial accounting is mainly maintained to ascertain the profit or loss of a business during a particular period. So, it may be a particular accounting period. It may be from 1st April to 31st March. And to state the financial position, that is said to be the balance sheet as on a particular date. So, whenever the balance sheet is prepared, it is on a particular date. It is on 31st March. So, on 31st March, what are all the total liabilities? What are the total assets a business owns and owes? Next is cost accounting. The objective is to find out the cost of goods purchased, goods produced and services rendered by the business. It also helps the business in controlling the cost by indicating avoidable losses and wastages. Now, when we say cost accounting, it is said to be cost ascertainment, cost control and cost computation. So, when we say the cost, it is the main item is to ascertain the cost. What are the total costs that has been incurred in terms of material, in terms of labor, and in terms of other expenses. So all these costs are computed, and we are going to say how these costs can be controlled. So when the cost is controlled, we are going to identify the areas in which the losses can be controlled, the wastages can be controlled. Assume a material can be wasted normally or abnormally. The normal losses cannot be avoided, that is like evaporation, shrinkage. So these items cannot be avoided. But in case of abnormal losses, say when we are going to, inefficient handling of your material, inefficient instructions that have been given to the employee for handling of material. So all these things are said to be abnormal losses. The losses regarding your theft, fire, and other natural calamities. So all these things can be avoided by way of ensuring we can avoid it, losses by fire and other natural calamities. And again, by giving proper instructions to the employee, we can avoid the wastage of materials in handling. So all these things can be avoided. That is called as abnormal loss. So when we say normal loss, these cannot be avoided. It is during your production, it has to be incurred, and it will be very meager, like 1% or 0.5%. In case of labor also, we have normal loss and abnormal loss. Normal loss will be the time that is taken by the laborers to take the instructions from his own superiors, to take the raw materials from the stores, and again to walk from one department to another department. This is said to be the normal loss of time that cannot be avoided. And these actions are said to be incidental actions to your main action. But in case of other items, say for example, when he is waiting for the supply of materials abnormally, and again when he is waiting for the instructions from his own superiors, so that is called as abnormal loss of time. He may lose the time abnormally, so he may waste the time. That is called as idle time. This idle time can be controlled. This abnormal loss of materials can be controlled. So all these items can be controlled. So this can, when you are going to control the cost, it is said to be the reduction in the cost. So when we have a reduction in the cost, it will lead to the fixation of your selling price in a very easier manner. So the selling price may be fixed at a lower price, and we can go for an increase in the sales, which will in turn result in the increase in the revenue of an enterprise. So this cost accounting plays a very important role in deciding about the cost ascertain and cost control and fixation of your selling price. So next one is we come to the management accounting. Management accounting is said to be an area in which the managers, namely the board of directors and the top management, is able to decide based on your financial and cost accounting. So when we are going for your decision making by the managers, we are going to utilize certain techniques in management, namely the ratio analysis, budgetary control, capital budgeting, and we have various other techniques like standard costing. So through these techniques, a management can control and make a decision in your business enterprise. Uses of accounting information. We shall see how this accounting information is useful to the external people. The first one is the investors. Investors are interested in the financial health of the organization because they want to know about the safety of their investment. Next is creditors. To know the liquid position, they need accounting information relating to the current assets, quick assets, current liabilities, which is available in the financial statements. Normally, they are interested in the working capital position of the organization. Working capital position is equal to current assets minus current liabilities. So this working capital position increases whenever the current asset increases and your current liability decreases. Now working capital position decreases when the current asset decreases and your current liability increases. So this is a position in an organization. So working capital is equal to the current assets and current minus your current liabilities. It can be otherwise called as net working capital. So net working capital woman, the difference between your current assets and current liabilities. So this working capital is said to be the economic barometer of any organization. Next is members of non-profit organizations. These members of non-profit organization wants to know how their contributed funds are being utilized and to ascertain if the organization deserves to continued support or not. So only when the organization is deserving to get their funds, they are going to extend the funds. Next is government. Both the central government and state governments are interested in accounting information because they want to know the earnings or sales mainly for taxation purposes. So to collect the corporate taxes, they want to know whether the business is earning the profit, and if it is earning the profit, what is the rate of profit they are earning. Next comes the consumers. The consumers needs the accounting information because they want to know the selling price, which is based on your cost of production. And when there is a reduction in the cost of production, they expect a reduction in the selling price also. The next comes the research scholars. These research scholars use the financial accounts mainly to interpret, and they want to use it for your assessing the financial performance of a business organization. Next comes the internal users. The internal user is the owner. The owner woman, the person who has invested the money. So he wants to know about the profitability and also the financial position of a concern to know about whether the amount invested have been effectively utilized. Next comes the management. The management is using the accounting information mainly to appraise the performance of the subordinates. So he wants to assess whether the subordinates are working as per the targets fixed or not. And again, they want to make the different managerial functions like planning, controlling, decision making, etc. And it is also useful to fix up a selling price as for its products. The next one comes the employees. The employees are interested because they want to know about their bonus, the amount of bonus, which depends upon the size of the profits earned by the organization. Now we shall see the various systems of accounting. The first comes the cash system. When we say cash system, the accounting records will record whatever the cash is received and whatever the cash is paid, irrespective of your outstanding incomes, outstanding expenses, income received in advance, and your prepaid expenses. Now, under this system, actual cash receipts and actual cash payments are recorded and credit transactions are not recorded. This is very important. Credit transactions, women, the money will not be paid or received on the date of transaction. Assume if you are selling goods for cash, so cash will be realized on the same date of sale. If you are selling goods on credit, so the goods will be transferred now, but the payment will be made on a next day or a next month or a next week. So when we say it is paid on the next day, it is said to be a credit transaction. Same way, purchases. When the purchases are made for cash, the cash is paid on the same day. When it is paid on a different day, it is called as credit transaction. So credit transactions are not recorded in the books under cash system. So this system does not make a complete record of financial transactions during a particular trading period. Next comes the mercantile system or accrual system. This is the system normally what we are following. So under this system, all transactions relating to a period are recorded in the books of accounts. In addition to the actual receipts and payments of cash income receivable and expenses payable are also recorded. This system gives a complete picture of all financial transactions of the business as it makes a record of all transactions relating to the period. So in this case, we are going to record the outstanding expenses, outstanding incomes, Then we have prepaid expenses. Then income received in advance. Income received in advance. See, whenever the expenses are not paid, that is called as outstanding expenses. Assume when we are closing on 31st March, the salary for the month of March is not paid. So that is said to be an outstanding expense. So this outstanding expense is said to be a liability because which is to be paid. Then outstanding income amount for the month of March, we didn't receive the dividend, we didn't receive the interest. So this interest or the income that is outstanding is said to be an asset. Now prepaid expenses. Normally all the insurance premium will be prepaid. So when we are prepaying the expenses, it is said to be an asset because our money is with the insurance company before it becomes due. Now income received in advance. When we are receiving customer advances, so that is said to be income received in advance. So we are receiving the income before it becomes due. So it is said to be a liability. So all these items, namely the outstanding expense, outstanding income, prepaid expense, income received in advance is said to be the items which are emerging or merging from your accrual system. So accrual system amount, whenever it becomes due, we are going to write it on the books of accounts. Now we shall see the advantages of financial accounting. As we already said, it replaces your memory. So a human mind cannot remember all the accounting transactions or all the business transactions to be accounted for. So it replaces the memory. Next is it assesses the performance of the business. It is very important. So based on this past records, we are going to based on the accounting records, we are going to prepare the income statement to know the profit earned or loss suffered by the concerned business. So we can very well know about the performance of the business. Next is assess the financial status of the business. So it reveals the true position of the business on a particular date. So we can know about the various state of assets and liabilities. So all your assets are known. So asset is always equal to liabilities plus capital. So this can be easily assessed. So what is your capital invested and what is your liability that is owed by the business to the outsiders and what are the assets owned by the business. The next comes the documentary evidence. So it is a proof which can be shown in the court of law as an evidence. Then assisting in the realization of debt. So we can easily understand what is the amount due from the debtors. Then facilitating the sale of business. So when you are going to sell the business, we can easily revalue the assets and liabilities. Preventing and deducting frauds. So when we are preparing the records in a very orderly manner, we can easily find out what are all the frauds that have been committed by the employees. And it is helpful to the management to assess the achievements of the business organization. Next comes the disadvantages of financial accounting. It ignores the qualitative aspect. Say for example, the reputation of the management, the morale of the employees and the labor strike, etc. So this quality aspect is not recorded in a business concern. Then it's a biased accounting information. This is said to be biased and manipulative data because when the management wants to show a good financial report, it is going to show a different scenario which is feasible and which is advantageous to them. So this is not revealed, this cannot be easily revealed by the financial reports. Though we say that the full disclosure of the information should be made. Sometimes the corporate management may manipulate their records and they may give a biased statements. Next is it ignores the present value. So all the assets that have been purchased is made only at the cost price. So it ignores the present market value of all the assets. Then inexactness. Inexactness, women, it evaluates the profit or loss on the basis of the real and planned estimates. Say for example, we are going to predict 1% bad debts and we are going to predict 2% provision for bad debts. So all these things have been predicted. So based on this, we are going to prepare the accounts. Again, in case of valuation of stock, the calculation of your depreciation on fixed assets, we have various methods of following, can be followed in the valuation of stock and your depreciation. So in this case, inexactness may be there, maybe inconsistency may be there between two records. So far we have seen the advantages and disadvantages of financial accounting. Let us see the various characteristics of accounting principle. What is accounting principle? So to have a uniform set of rules and guidelines, we have to ensure the uniformity and easy understanding of the different accounting information. So human made, therefore, derived from the experience and the reasons. So all these accounting principles are said to be human made and they are derived from the experience and the reasons. Then it is not static and it is bound to change with the passage of time. Then it depends upon the relevance, objectivity and feasibility. Relevance, women, whatever that is relevant, whatever that is connected with your business, we are going to show it. Objectivity, women, we must have some objective evidence for every transaction, and feasibility is it has to be incurred. Say any likely to happen events will not be entered here. The categories of your accounting principles is, first one is your concepts, second one is your conventions. Let us see the different concepts and conventions in detail. What are the accounting concepts? This concept provides for the foundation of your accounting process and enables the user to understand the financial statement of any enterprise in a better way. It may be considered as postulates or its basic assumptions or conditions upon which the accounting records are based. We shall see each and every concept in detail. First, we shall see the business entity concept. When we say business entity concept, the business and the owners are said to be two separate entities, and in accounting records, the proprietor's account will not be entered. So his personal account is not entered. We assume the proprietor has extended the cash to the business. That's why we write it as capital account and it is written on the liability side because the business owes money to the proprietor. Or put it another way, the proprietor has extended money to the business. So this is called as business entity concept. We assume the business as a separate entity from the proprietor. Next is money measurement concept. So money measurement concept, women, all the transactions are entered only in monetary terms. The physical units are not entered. Assume when we take furniture, it is worth rupees 1 lakh. So we don't write 10 tables or 20 chairs and 30, the other racks and other things. So we should not write it in physical units. We are going to write it in the value of your furniture. Again, in case of buildings, we don't write it in square feet. We are going to write it in the value of your building. Why this money measurement concept is followed? Because the comparison of your financial statements over the years and between the organizations of the same year is possible only because of this money measurement concept. So this assets and liabilities are recorded in a common medium of exchange called as money. So this physical transactions, physical units are not recorded here. Next is going concern concept. This going concern concept is very important and we assume the business is going to continue in future. So it is a going concern. That's why we have opening balances and closing balances. The accounts are closed at the end of the year and we are transferring to the next year, assuming that the business will carry on in the next year. And a common saying is that whenever men may come and go, but the company will remain forever. We may have a change in the ownership, but the company will remain forever. So this business unit has a reasonable expectation of continuing the business at a profit for an indefinite period of time. That is very important. So it is deemed to be a going concern and not a gone concern. It will continue to operate in future. Next is cost concept. Any asset that has been purchased will be recorded only at the cost price. So it is, and the book value is entered in the books of accounts, but not the market value. Market value will be calculated only when the business have been sold to another concern or another entity. Next is dual aspect concept. Dual aspect concept, women, we have two aspects in every transaction. First one is yielding of benefits. Second one is your giving of benefits. So each and every transaction will have a giving aspect and another aspect is your receiving aspect. Assume you are paying rent. So the rent will be paid by the tenant and it will be received by the landlord. When we are paying the commission, so we are paying and the agent is receiving it. So there will be one person receiving the benefit and there will be another person giving the benefit. This is called as a dual aspect of accounting. So each and every transaction will have dual aspect. Next is accounting period concept. This is very important because when the accounting records are kept on a continuous basis, but the owner wants to know whether the business is earning a profit or not. So when we wants to know about the profit or loss made, then he has to close his accounts and find out whether the business has earned a profit or not. So this closing of your accounts will be made on a specific period of time, normally the 12 months. This 12 months period is called as accounting period concept, and this accounting period will be normally the financial year starting from your 1st April to 31st March. So as a business is a going entity, it will continue indefinitely and one has to wait for a very long period to estimate the financial result of the business. So the accounts are closed for the period of 12 months to know about the profit earned or loss suffered during the period. Our Income Tax Act 1961 specifies the financial year from April to March as the accounting period. Next concept is matching concept. So whenever this matching concept is followed, we are going to recognize the expenses in the same accounting period in which it has the revenues have been related. So we are going to match the revenues and your expenses to find out the profit or loss. So that is your matching concept, whereby the expenses are recognized in the same accounting period as the related revenues are recognized. So all your expenses for that particular 12 months and all the revenues for the particular 12 months will be recorded and then we are going to match it. Realization concept. Realization concept means the revenue is realized only when the goods and services related to the services delivered or rendered. Say for example, when we are making a sale on credit, so sales is recorded only in this month and we are going to receive it in the next month. So cash will be received in the next month, but we are going to record the sales only in this month because it is realized. The sale has been realized only in this month. This is called as realization concept. So we are going to record the transaction in which the revenue has been realized in a particular month. Next is accrual concept. As we already said, accrual concept deals with the outstanding expenses, outstanding incomes received in advance and your prepaid expenses. Next comes the objective evidence concept. This objective evidence concept says that each and every transaction must have an evidence. That is, we normally in auditing we call it as vouching. Vouching women, we are going to have the voucher for every transaction. Voucher women, it is a documentary evidence that is said to be the basic evidence of any transaction. Say when a sale is made, the invoice is said to be the voucher. When a purchase is made, the invoice given by the supplier will be the voucher. When a salary is paid, the salary slip will be the voucher. So voucher woman, it is a basic document, it is a primary document on the basis of which the transactions are being entered in an organization. So this concept ensures that all accounting must be based on objective evidence. That is, every transaction is recorded in the books of accounts must have a verifiable document in support of its existence. So these are all the concepts regarding your accounting. Next comes the conventions. Convention may undergo a change with the time, but change in quality of accounting information will be the outcome. They also denote the circumstances which guide the accountants while preparing the accounting statement. We shall see the first convention, that is your full disclosure. Full disclosure woman, the proprietor of the organization or the owner of the enterprise must disclose the entire information to the outsiders and also the insiders, namely the stakeholders. All significant information relating to the economic affair of the enterprise should be completely disclosed, such as proprietor present and potential creditors, the investors and other stakeholders may understand. The convention of disclosure also applies to the events occurring after the balance sheet and the date on which the financial statement are authorized for issue. So this disclosure will also apply to the events occurring after the balance sheet. Assume we are preparing the balance sheet on 31st March. We have certain events, like say for example contingent liabilities, which may or may not occur in future. The best example will be bills discounted likely to be dishonored and a case pending in the court. So when any workman compensation case is pending in the court, the result may be, the verdict may be against the company or for the company. So based on your verdict, we are going to have a liability. So all these contingent liabilities will be entered at the footnote of your balance sheet. Next is consistency. Consistency, you must have a uniform way of recording the transaction. Say for example, when we have the valuation of stock and valuation of your asset, fixed assets based on your rate of depreciation, we must follow a consistent way of calculating the stock value or your fixed asset value. Only then the comparison makes the meaning. Say for example, the accounting practices should remain unchanged from one period to another. It requires that working rules once chosen should not be changed arbitrarily and without any notice of the effect of change to those who use the accounts. So when you are going to change your calculation of depreciation from straight line to written down, now as per your Income Tax Act, we go in for the written down value of assets. So when we go change the depreciation method, we must have proper adjustments regarding the change in the value of your asset. So all these things must have a consistency in recording your business accounting information. Next is conservatism. Conservatism women always expect all losses but not the gains. So we have to expect only the losses but not the gains in an organization. That is why we are creating a provision for depreciation, provision for your bad debts, provision for discount on debtors. So all these losses are expected but we don't expect any gains here. Then materiality. Materiality, women, any information which is said to be material, which is said to be significant, is recorded in the accounting records. So any irrelevant information is not disclosed. The unimportant items are either left or merged with the other items. Assume the petty cash. So when we come to the petty cash, this petty cash is merged with the main cash. So all these petty expenses, all your petty items will be merged with your main expenses or main items. We shall now see the various accounting terminologies. So we have seen the accounting concepts and conventions. Based on this, we have many accounting terminologies, that is the terms used in your accounts maintenance. First is transaction. As we already said, the transaction is said to be the exchange of goods and services. Next is voucher. Voucher is said to be the documentary evidence of any transaction. Next is capital. It is the amount invested by the owner in the firm and it may be brought in the form of cash or in the form of assets. Next is drawings. Drawings, women, any money withdrawn from the business for the personal use. That is very important. The owner may take from the business cash or goods for his personal use. Say for example, if he is running a stationery shop, he may take some sort of papers or other pencils, etc. for his personal use. So whatever he takes for the personal use, it should be written as drawings. Anything drawn from the business. Then goods. Goods, women, any items which are purchased for the purpose of resale is said to be goods. Anything which is purchased for your consumption is called as asset. So when we say the goods, it should be meant for your resale. Assume the real estate owner will purchase the land mainly for the purpose of selling it. But in case of your, end consumer, he may purchase a land to construct a house. So when he is purchasing for his personal consumption, it becomes asset. When he is purchasing for the purpose of resale, it becomes goods. Next is purchases. Purchases, woman, any goods that is procured for the purpose of resale. In case of trading concern, the final goods will be purchased. In case of manufacturing concern, the raw materials will be purchased. And the purchases may be either cash purchases or credit purchases. Next comes the sales. Sales, woman, the total revenues from the goods sold or services. And this sales again is said to be cash sales or credit sales. Next is stock in trade. Stock in trade, woman, any stock that has been maintained, any goods that have been maintained at the end. So it may be either at cost price or at the market price, whichever is less. So when it is maintained at the end, it is called as closing stock. So next is cost of goods sold. Cost of goods sold is said to be the cost of the goods that has been sold by the business. That is, it may be sales minus GP or opening stock plus purchases minus your closing stock. Next is credit. Credit and debit. These are all the two aspects in a double entry bookkeeping. Accounting entry that may either decrease assets or increase your liabilities and equity. It is called as credit, depending upon the transaction that is occurring. When using the double entry bookkeeping method, these two recorded entries of every transaction, a credit and a debit. Debit per month, it increases the assets and decreases your liabilities and capital. Journal. As we said, it is a book of prime entry where the business transactions are entered in a very chronological order, that is order of appearance according to the time that is appearing. Posting. Posting, women, it is a transfer of entries from journal to ledger. Ledger. It is a book where the accounts are organized in a very classified manner. Subsidiary books. Subsidiary books are said to be the books which are going to replace the journal. So it is subdivided into various journals for recording the transactions of a similar nature, again in a chronological order. Next is assets. Assets are said to be the economic resources of an enterprise useful in its operations. Assets are broadly classified into two categories. First one is your fixed assets, second one is your current assets. Fixed assets are those assets which are purchased on a long-term basis. Here we have to note a point. Fixed assets involves huge investment and it is for a long term and it increases the capacity to produce, capacity of your earning. So whatever that is purchased in long term, say for example land and building, plant and machinery, furniture and fixtures. So all these items will increase your capacity of earning. That is called as fixed assets. Assume I am going in for a next plant. Plant, women, the place in which the production is carried on, actual production is carried on. If I am going for an additional machinery, so that will increase my capacity. So increasing of seats in a cinema theatre, increasing of seats in an educational institution. So this is said to be the fixed in nature. So this will increase your earning capacity. That is called as fixed assets. Current assets are those assets which will be converted easily into cash. That is, conversion factor should be considered. So say for example stock, data, bills receivable, all these items are said to be the current assets, cash in hand, cash at bank, etc. Liabilities. Liabilities are said to be the obligations or debts of an enterprise which has to be paid in some time or in future. This again a long-term liability, it is said to be a short-term liability. Long-term liability, women, which is more than 1 year. Say for example debentures, any loan, term loan received from your financial institutions are said to be long-term liabilities. Short-term liabilities are those liabilities which are paid within a year. Say it is bank overdraft, sundry creditors, creditors for expenses, any outstanding expenses, for all items which is said to be the short-term liabilities. Next is revenues. Revenues, women, the income from the any source. It should be of regular in nature. For example, sales, commission, interest and dividends. So the occurrence will be in a repeated manner. That is said to be revenue. Next is expenses. Expenses woman, the cost incurred by the business for earning the revenue are called as expenses. So any amount that has been spent mainly to earn a revenue, example salaries, wages, rent, interest, commission. So all these expenses are met mainly to earn a revenue. Next is expenditure. Expenditure woman incurring a liability for acquiring assets or goods or services. The expenditure may be revenue expenditure or capital expenditure or deferred revenue expenditure. Revenue expenditure are said to be the expenditure wherein the benefit of that expenditure will be incurred in the same year in which it has been spent. Say for example rent, interest, etc. So we are paying the rent and we are utilizing the place. So that is called as the revenue expenditure. Capital expenditure woman, the expenditure will be made now but the benefits will be over a period of time. Say machinery, land and building, furniture, etc. Deferred revenue expenditure is revenue in nature but is incurred during a current year wherein the benefits are in the future accounting periods. The best example will be advertisement, preliminary expenses are said to be the deferred revenue expenditures. We are incurring the expenditures in this year and the revenues are earned in the coming years. Next is expenses. Fixed expenses. Fixed expenses woman, the particular amount will be incurred over a period of time. That is said to be fixed expenses. That will be constant over a period of time. Variable expenses woman, it varies according to your output. So irrespective of the output, if the expenses remain to be constant, it is called as fixed expense. If it is to be changed, it is called as variable expense. Assume the investment and plant and machinery is said to be fixed in nature. So it is to be constant, whatever may be the level of production. Assume if the machinery is have a capacity of producing 5,000 units of rupees 50 lakhs. When you are going to produce 100 units, the same 50 lakhs is incurred. When you are going to produce 5,000 units, the same 50 lakhs is incurred. That is said to be the fixed expense. Variable expense woman, per unit will be constant. So when per unit is constant, when the output increases, the total cost will also increase. Total variable cost will also increase. So total fixed cost remains constant and variable cost per unit remains constant. Next is we have accrued expenses. Accrued expenses women, the expenses which have not been paid. That is normally we call it as outstanding expenses. Then operation expenses. Operation expenses women, any expenses concerned with the production of goods or services. That may be any operating expenses, namely salaries, advertising, rent for the building, right, electricity charges, postage, telegrams, printing, stationery. So whatever may be the expenses we are going to incur, that is called as operation expenses. Then accrued expenses. Accrued expenses women, expense that has been occurred but not recognized in the accounts. That is said to be the outstanding. Then prepaid expenses, as we already said, any expenses which are paid in advance. So that is called as prepaid expense. So before earning the revenue, we are going to pay the expense. Then accrued income. This is said to be the outstanding income. Income has accrued, but it has not been recognized. Then income received in advance, that is otherwise called as unearned revenue. So income in the current year is received, but the amount relates to the next accounting period. That is called as income received in advance. Next is bank reconciliation. This is very important. When you are preparing in the third 3-columnar cash book, the bank column of the cash book should be tallied with your bank passbook. The bank passbook, the very name says that is the book which passes between your banker and the customer. So the balance as per your bank passbook and the balance as per your bank column of cash book may be the same. But normally it will not. It may be due to many reasons. Assume when the checks are deposited in this month but not collected, it may be collected in the next month. But the checks issued may not be presented for payment during this month. On any direct deposit by the customer to the banker, any standing instruction that has been followed by the banker, right? So these are any financial incomes that has been entered here but not entered in your bank passbook. So all these items may make the balances to differ. So we are going to reconcile, we are going to balance the accounts of bank account and also your passbook. So this is called as bank reconciliation, a process by which an accountant determines whether and why there is a difference between the balance shown on the bank statement and the balance of cash account in a firm's general ledger. Next is contingent liability. Contingent liability is said to be the potential liability arising from the past transaction or a subsequent event. As we already said, it may be bills discounted likely to be dishonored or any other expenses or any other liability that may happen in future. Depreciation. Depreciation is said to be the decrease in the value of asset that may be due to wear and tear or reflection of time, changes in the technologies, etc. So this depreciation will be calculated over the estimated useful life of the asset. So at the end of the life of the asset, we are going to replace the asset. So for this purpose, this depreciation is created, and this depreciation is a non-fund item. It is said to be a tax deductible amount, and it is shown on the debit side of profit and loss account, and sometimes the corporate may use it as a secret reserve also. So this depreciation is created mainly to replace the asset after the end life. Goodwill. Goodwill is said to be the premium paid in the acquisition of any entity over the fair value of its identifiable, tangible and intangible assets, less liabilities assumed. So this goodwill is said to be any excess that has been paid over your purchase consideration. So when we say that net tangible assets, when your net assets are said to be, when your purchase consideration is more, when your net assets are less than your purchase consideration, we say we have goodwill. When it is more than the purchase consideration, it will result in purchase capital reserve. Next comes the operating cycle. Operating cycle, woman, it is the time taken to convert your raw materials into a finished good. Cash again. Assume in a manufacturing organization, we will start with the cash, purchase of raw materials converted into work in progress into your finished goods into your sales into your datas into bills receivable, again the bills receivable into cash. So this is said to be the operating cycle. So it is acquisition of goods and services involved in a manufacturing process and a final cash realization resulting from the sales and subsequent collections. Suppose if you are a trading concern, it will be cash, finished goods, datas, bills receivable and cash. So this will be the operating cycle. What is the time for converting your cash into cash again, right? Profit. This is the excess of your revenues over your related expenses. So revenue minus your expenses. Gain. This gain differs from your profit. Profit, moment, any amount that has been earned through the stress and strain of the entrepreneur, but the gain is not so. Say any appreciation in the land and building cost, any appreciation in any of your value of asset due to the economic policies of the government, etc. So that is called as gain. So this gain is said to be non-recurring and it is not a profit. So profit is the amount earned through your stress and strain, but your gain is said to be incidental to the business because due to your sale of fixed assets, appreciation in the value of asset, etc. Next is loss. Loss, woman, it is excess of expenses over its related revenues. So when your expenses are going to exceed your revenue, it is called as loss. Then discount. Discount is a rebate given by the seller to the buyer. It can be classified as trade discount and cash discount. I'll tell you what is cash discount and trade discount. Trade discount is normally given by the manufacturer to the purchaser to encourage bulk purchases. So the purpose of this discount is to persuade to buy or to buy more goods. It is offered at an agreed percentage of the list prices. List price among the invoice price at the time of selling the goods. So this will be deducted in the invoice itself, and this trade discount will not be carried to the journal. Next is cash discount. Cash discount is given mainly to encourage the debtors to pay the dues promptly, and this discount is recorded in your accounts books. Assume you are selling it for 1 lakh rupees and we are getting from him only 97,000. So this 3,000 is said to be the cash discount, and it is said to be an incentive to the debtors for the early payment. Then debtors. Debtors are the persons or the entities to whom the business has sold goods on credit and the amount has not yet received. So these are the assets of the business. This is very important. So these are said to be the assets and shown on the asset side of the balance sheet. Next is creditors. Creditors means if the buyer business buys goods on credit and the amount is still to be paid to the persons or to the other entities, they are called as creditors and they are said to be the liabilities of the business. Next is accounts receivable. Accounts receivable or a bills receivable. So when the debtors are having a credit period of 3 months, so for this 3 months they will give a bill. Say when we are selling goods to the our customer, so myself will write the bill and I will be the drawer of the bill, saying that so and so will give the money to me after 3 months for the value of. So the customer of my concern will accept the bill and give it back to me. On the due date, I will get the money and will return the bill. So that is called as bills receivable, and this bills receivable is normally said to be an asset. Again, this bill is said to be receivable for me and it is payable for the customer. So it is a liability and the same bill will be accepted by me for my creditor. So that is called as a liability. Trial balance. This trial balance is prepared to mainly to check the arithmetical accuracy of your business books of accounts. So it's a business document in which all ledgers are compiled into debit and credit columns in order to ensure a company's bookkeeping system is mathematically correct. So this trial balance is mainly prepared to know about the ledgers are correctly balanced or not. So if the trial balance is not tallying, we can find that there are certain items that have been left out, or there may be some corrections to be made in the principle itself. At times the trial balance will also tally, but we have to find it out whether the errors are being compensated in the ledger itself. So we may have a wrong casting, we may have a wrong posting, or we may be having a error of principle itself, treating your revenue item as a capital and a capital item as a revenue, etc. Next is income statement. This income statement is said to be the summary of all your revenues and expenses over a period of time, and this income statement reveals the profit or loss. Next comes the balance sheet. Balance sheet is said to be the financial report that shows the company's assets and liabilities. So on your liabilities and capital side, so we will have all your sources and we have the assets here. This is said to be the applications. So this is said to be the applications of your sources. We have application, here we have the sources of funds. So this is said to be the balance sheet. Next is cash flow. The revenue or expenses expected to be generated through the businesses is over a period of time is called as cash flow. What is the real cash flowing inside and what is the real cash that is going outside the business. Next is certified public accountants. So any person who has passed the CA examination will be the certified public accountant. The next is generally accepted accounting principles, that is GAAP. This is followed by the accounting industry for companies to follow when reporting your financial data. Next is gross margin. Gross margin is your sales minus COGS. Then net income. Net income or net loss, excess or deficit of your total revenues and gains compared with your total expenses and losses for an accounting period. Next is we have the equity and owner's equity. So in most general sense, equity is asset minus liabilities. Owner's equity is typically explained in terms of percentage of interest a person has ownership in the company, and the owners of stock are called as the shareholders. Expansion. The process of increasing the production without varying the main production process or types of products produced. Say when we are expanding, we are going to expand in the same line of business. When you are engaged in a petrochemical industry, we are going in for a next unit or for a next plant, increasing your volume of production. That is called as expansion. But when we say diversification, when this petrochemical industry is totally deviating its business to another iron and steel or textile or pharmaceutical, then it is called as diversification. Allocating or spreading the capital investments into a varied assets, it goes to a different state of affairs. Next is insolvency. Insolvency, women, when your assets are lesser than your liabilities, that is said to be insolvency. No, it cannot meet your financial obligations. So these are all the basic accounting terminologies that are used in our accounts. Next we shall see what all the different kinds of accounts we are going to maintain. As we already said, double entry bookkeeping has personal accounts, real accounts and your nominal accounts. Now we shall see personal account. Personal account we have natural personal account, artificial personal account, representative personal account. Natural personal account we mean the human beings, Raman account, Mohan account, Sohan account, Somu's account. So this is said to be the personal account. Natural personal account. Artificial personal accounts women, all the business entities, the clubs, societies, banks, joint stock companies, partnership firms. So all these things are called as artificial personal accounts. Then representative personal accounts. So all these representative personal accounts take into account the outstanding expenses, outstanding incomes, incomes received in advance and prepaid expenses. Next comes the real accounts. The real accounts may be tangible and intangible. Tangible items are said to be the items which can be touched and felt. So the buildings, all your physical assets, namely buildings, land, machinery, stock, etc. Intangible assets, women, you cannot touch and feel, but we can understand the very basic concept of your account assets, namely the goodwill, patents, trademarks, etc. This can be otherwise called as fictitious assets, which cannot be seen with the natural eyes. Next is nominal accounts. Nominal accounts means the word nominal, women, existing in name only. So all your expenses, all your revenues are said to be nominal in nature. We cannot see salary, we cannot see commission, interest, dividend, right? Stationery expenses, managers remuneration, legal fees, auditors fees, so rent, electricity. So all these expenses will be met only through cash. So all the accounts can be seen only in the form of cash, but we cannot really see all your expenses and incomes. Accounts which are related to expenses, losses, incomes or gains are called as nominal accounts. It does not really exist in a physical form, but behind every nominal account, money is involved. This is very important. The cash is going to be the final way in which it has been dispersed. So the final result of all your nominal accounts is either profit or loss, which can be transferred to your capital account. Now we shall see the different steps in accounting cycle. First is identify the business events, write it in journal. Then post the entries in ledger. Then we'll have unadjusted trial balance and then analyze the trial balance. Then post adjusting journal entries and prepare an adjusted trial balance. Then adjusted trial balance is used to prepare the financial statements. Then prepare your temporary income statement with all your closing entries. Then post closing trial balance for the next accounting period. So prepare reversing entries to cancel the temporary adjusting entries if applicable. So these are the various steps in accounting cycle. Finally, we can see the golden rules for your double entry. Personal accounts, debit the receiver, credit the giver. Then real accounts, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. So this is said to be the golden rules for double entry. Only based on these golden rules, we are going to analyze each and every transaction, find out what are all the different accounts involved in any transaction. Definitely there will be two accounts involved in any particular transaction. Assume introduced capital. So we have cash and capital. So when we have purchase goes for cash, we have cash and purchases. So in every transaction we have two accounts. Then after identifying the accounts, we have to say the rules for the accounts, whether it is personal, say the rule for the personal and say the rule for your real, and then find out which one is to be debited and which one is to be credited, and then pass the entry in the journal books. So these are the references that has been made for the accounting, introduction to accounting. Hope you would have understood the very basic of accounting, the very meaning of accounting, the need for accounting, objectives, advantages, disadvantages, the various terminologies used in the accounting, and we have the accounting concepts, conventions, and the various accounts that are being followed in the bookkeeping. So these are the various basic rules for any double entry bookkeeping. Based on these records, the accounting information has been prepared, which is said to be the very basic way in which the organization is going to speak for the outsiders. So the entire stakeholders, both the internal and external stakeholders, are dependent on the financial statements to know about what is happening inside the organization and what will happen in future and whether the company is progressing or not. So this accounting information is said to be the language through which the business is going to speak with the outsiders. So on seeing the financial statements, any person can come to know whether the business is progressing or not, and what are all the different policies that are being implemented in the organization, what are all the impact on those policies, and what is the next move of the management for the any pitfalls or any growth in a organization. So this financial statements are said to be very important for any organization, and it has to be maintained in any organization. Hope you would have understood all the basic information. Thank you.